Have you ever wondered if investors are focusing too much on interest rates? This is a question that's been echoing in the financial world recently, especially as we see markets drifting lower due to the potential for higher rates. At first glance, it seems like a legitimate concern. After all, interest rates play a critical role in our economy. They influence everything from the cost of borrowing to the return on investments. But are we giving them too much credit? Are we letting the tail wag the dog, so to speak? Let's take a step back and look at the bigger picture. Yes, interest rates have been on the rise. But let's not forget, they are not as high as they have been in the past. In fact, these hikes are a result of central banks tapping the brakes on a growing economy. It's a normal part of the business cycle, a sort of economic ebb and flow. So why the panic? Well, it's human nature to react to change, especially when it involves our hard-earned money. But it's also important to remember that investing is a long-term game. It's about looking past the short-term fluctuations and focusing on the bigger picture. And let's not forget about the other players in this game. Private equity firms, corporations, even the humble IPO, all have a part to play in the market's direction. They're like the pieces of a puzzle, each contributing to the overall picture of our economy. So, it's not just about interest rates, it's about understanding the market as a whole, looking at the historical trends, and making informed decisions. So, are we obsessing too much over interest rates? Let's dive a bit deeper. To answer this, we need to look at historical trends. Now, over the decades, we've seen interest rates rise and fall, creating waves in the market that savvy investors have learned to ride. It's a cycle, as natural as the ebb and flow of the tides. Let's rewind a bit. In the past, higher interest rates were a byproduct of central banks tapping the brakes on a burgeoning economy. It's not an accident or a disaster, but a deliberate measure to maintain balance. This is a normal part of the business cycle, something that investors have weathered time and time again. But how does this historical perspective help us today? Well, it allows us to step back and look at the larger picture. Instead of focusing on the here and now, we can examine longer-term scenarios. This broader view can provide valuable insight into where the market might be headed. Take, for instance, the actions of private equity firms and corporations. These entities, with their vast resources and market influence, often serve as an economic weather vane. By observing their activities, we can glean some idea of future market trends. Another useful indicator is the state of initial public offerings, or IPOs. A healthy appetite for risk, as demonstrated by a robust IPO market, can often signal positive market sentiment, even in the face of overall pessimism. So while it's natural to be concerned about rising interest rates, it's crucial to remember that they are but one factor in a complex economic ecosystem. And history shows us that panic is rarely a productive response. Instead, a calm and analytical approach, informed by historical trends and broader market indicators, can help investors navigate these choppy financial waters. Remember, history often repeats itself, but will it this time? Stick around to find out. Now, let's turn our attention to the current market scenario. We're seeing an intriguing dynamic at play. On one hand, the market has been drifting lower as investors mull over the impact of potentially higher interest rates. Yet on the other, we're witnessing a rally in U.S. stocks. In fact, Bank of America's shares surged over 6%, thanks to rising interest rates boosting net interest income, despite an increase in loan loss reserves. Moreover, it's not just a solitary phenomenon. The entire S&P 500 Banks Index was up nearly 3.5%, indicating that higher rates have been a boon for lenders in the third quarter. And here's another interesting tidbit. Even with the overall pessimism in the market, there's been a surge in initial public offerings. These IPOs are not just random blips on the radar. They represent a positive sign of risk appetite among investors. The market, it seems, is sending mixed signals, so where does that leave us? As we wrap up, let's revisit our initial question. Are investors focusing too much on interest rates? The answer is not as straightforward as it may seem. Interest rates are indeed an important factor in our financial ecosystem. They influence the cost of borrowing, the return on investments, and the overall health of the economy. However, fixating on them excessively can overshadow other significant indicators. Remember, higher interest rates are a natural part of the business cycle, a sign of central banks tapping the brakes on an expanding economy. It's not necessarily a cause for alarm. It's crucial to look beyond the immediate and consider longer-term scenarios, the actions of private equity firms and corporations to gauge where the market might be headed. In the end, it's all about balance. Balance in understanding the role of interest rates, balance in our investment strategies, and balance in our response to market changes. So, next time you hear about interest rates, remember to keep things in perspective. And don't forget to subscribe for more insights and share your thoughts in the comments below.